Asset Management is with us. Prateek, thanks for joining in and Happy New Year to you in advance. It's been a very tumultuous year, so to speak, but India has emerged strong compared to at least its peers in the global markets. What's the big trend that you're looking at in the new year?
No, Happy New Year to you and the viewers. I think what differentiated us from the globe was one, sustained recovery year. So recovery in various markets happened at different times. So in the first phase, when they recovered, they did better. In the second phase, when we recovered, we did better. And hopefully, if the strength of recovery continues, we could continue to do well. Now, increasingly, I think we should look at India in the context of India, not compare with the world. It is our fundamentals that are driving our market with our monies. Offshore investors are hardly coming in or going out. So in terms of flow, they are now a very small part of the equation. I think if Indian earnings grow next year and the year after, I think the markets should respond in a corresponding manner.
Prateek, wanted to get this sense on the rural retail demand. Earlier today, we had a chat with the management of V-Mart, and they indicated that we are seeing necessary spending, but that aspirational spending hasn't come through as of now. The festive season started off on a good note, but after that, it's not that it accelerated or saw incremental spending or follow through. And this is in a way a proxy for the rural economy, which has been floundering and languishing for a while now. And it can have ramifications of what the Q3 earnings show up. Can you tell us what is it that you've picked up on the ground when it comes to this rural recovery theme?
Yeah, so there are many things which are happening at the same time. So for one, this is the open up time for the country over the last 3-4 months. That's what's been happening. Cities have opened up. People from villages have moved to cities. So there is a movement of population. And in the prior period, people spoke about rural strength. That was because people from cities had gone there. So that changes the equation by 1% or more. Yes, as it gets into the base, we have to see on top of it how it works out. Now, there is weakness. There is weakness at the lower strata of society for sure. Let's not wish that away. It is there. These are guys who are only now getting work and rebuilding their savings. So the consumption in that part would be weak. I think we completely get that. The story going forward is not of strong sales increase, not yet. Maybe in 2024, towards the end of 23, that could emerge as well. But as of now, the story is of reemergence of margins. Margins in India Inc. Got cut over Q1, Q2 because of very sharp commodity price increase. So even though the companies increased selling prices, margins declined. And there was, of course, inventory effect. Now, as we get into Q3 and beyond, I think that is where we start to see hope. If companies can maintain their pricing discipline and don't gun after market share, because it's a zero-sum game, any which ways. If they maintain pricing discipline, I think we will see reemergence of margins, better margins sequentially and on YOY going forward, which will drive earnings in over the next 2 quarters of 23 and in financial 24.
Okay, so give us some big trends, right, Prateek? I mean, what do you see as the themes that would work in 2023, and which are the spaces that you would avoid? I know it's a lot of crystal ball gazing that you need to do, but try for us. Tell us what should viewers watch out for?
So the year changes, but the markets, continue. So it's not as if completely new themes emerge. I think, yes, at the end of the year, we do this, what worked, what did not work, and maybe a new trend emerges. In terms of continuity, I do believe the themes of last year, the year before, such as lenders, will continue. I think here, the fact that NPAs are low and will continue to be low would support earnings. There was a fear that loan growth could slow down given that credit deposit ratios were no longer very conducive, is now slightly receding. So I think this is one space which could continue to do well. The other space is, the theme on China plus one. Maybe on top of it, we have a buildup of Europe plus one. So on the engineering side, on the chemical side, one should continue to be positive. Similar on the defense side, the outlays should be expected to be maintained, if not increased, and the substitution of imports should continue very deep into the future. So, but one new thing that can happen is the focus of the tech companies which got listed, let's say, over the last 1 odd years, from growth only to profitable growth. And that has valuation implications, especially at stock prices, which are probably a fraction of what they listed at. So I think the new year could see some more interest there. In the so-called less cyclical defensive spaces, I think hospitals have made their mark. Medical chains have a huge tailwind of unorganized to organized shift. I think these are spaces that we are very clued on.
I just want to touch upon the point about these new age tech companies, which are now trading 60-70% lower, from where they were, say, same time last year. The year-to-date losses are more than 60%. You spoke about the street's focus on profitability. Many of them, like Paytm, for instance, have already outlined that in the next 12 to 18 months, we will become, I think, free cash flow positive or EBITDA break even. So, that path to profitability has already been outlined. So should the time to buy come in only once we see that profit, the company is, walking the line when it comes to delivering it? So perhaps only in the second half of the year? Or can one take the leap of faith and buy now because the valuations are attractive now?
No, so depends on the risk makeup of each individual. Here I would say many of these businesses will sustain. So, some of the names that you took, will they be around 5 years hence? Will they be around 10 years hence? Maybe the answer would be yes. So it's not as if these are businesses which have been created and like many other tech companies will evaporate. That is not the case now. So these are good businesses, but if you look at the makeup of the current investors, expect a very large investor churn. The current holders will probably, a very large part of them will change over the next 1 to 2 years. And that will cause a lot of stock price volatility in all of these new age businesses, is my sense. So good businesses, not so strong holders is my thought process here. And which means, investors will, longer period investors will get chances to get in. They can wait it out a bit. They can wait out for more sense of, things actually happening rather than preempting it. But over the next 1 year, I think this is one space which could look much better.
All right, so we'll let you go on that note. Thanks a lot for joining in, Prateek. Have a great 2023.
Thank you.
And wishing your team as well. Thanks for joining in. Okay, well, that's about market opinion. Let's do one thing. Let's slip into a quick break. The market is picking up a bit of pace, but really all over the place for the index. So a big slide, now a bit of a recovery. So it's getting as volatile as can be. Let's discuss what's buzzing in the commodity space.